Have you ever wondered why your car insurance premiums went up, even though you haven't had a single accident? You drive safely, follow all the rules, yet your premium still climbs. It feels like a guessing game, but what if I told you it's not just about your driving history? There's a hidden force at play, your own psychology. Welcome to Insurance World TV, your premier insurance education channel. Today, we're pulling back the curtain on how behavioral economics is silently shaping what you pay for insurance. Stay tuned to the end of the video because we have smart tips on how to outsmart these biases and get real value from your insurance policy. Let's get started. First off, the definition. What is behavioral economics? Behavioral economics is a field of study that combines insights from psychology and economics to understand how people actually make financial decisions in the real world. While traditional economics assumes that people are rational, always making logical choices to maximize their benefit, behavioral economics recognizes something more human. People are emotional, biased, easily influenced, and often make decisions that go against their own best interest, especially under pressure, uncertainty, or when faced with too many choices. It looks at how emotions, mental shortcuts, habits, and biases shape things like saving, spending, and yes, buying insurance. Unlike classical economics, which assumes we're all rational decision makers, behavioral economics says people are emotional, often irrational, and companies know it. Let's say two people with identical driving records are shopping for car insurance. But one starts the renewal process early, visiting several insurance offices, asking questions, even negotiating. The other person waits until the very last day before their current policy expires. They're tired, busy, and under pressure to renew quickly. Believe it or not, the second person might end up with a higher premium or poor cover terms, not because of their risk, but because of their timing. Crazy, right? But it doesn't stop there. When you walk into an insurance office late in the day, or close to your renewal deadline, with no time to compare quotes or weigh options, it signals urgency. And urgency often equals less bargaining power. Insurance companies may be less inclined to offer discounts or alternative packages. They know you're unlikely to shop around or ask tough questions. On the other hand, your agent or broker may not have enough time to source for comparative quotes or effectively negotiate for better cover terms. So, what happens? You get a policy priced not just on your profile, but on your behavior and perceived desperation. That's behavioral economics in action. You're not just paying based on your driving record. You're paying for how prepared or pressured you seem. And unless you plan ahead, you might end up overpaying simply because of when and how you showed up. Psychological biases that impact your premiums. So far, we've seen that when and how you shop for insurance can influence what you pay. But let's take it a step deeper, because it's not just your timing or your habits. Sometimes, it's your brain's own hardwiring that's working against you, without you even knowing it. You see, human beings are full of mental shortcuts known as psychological biases. They help us make decisions quickly, but in the world of insurance, they can quietly cost you money. Coming up next, the biggest psychological traps that insurers understand all too well, and how they influence everything from the premiums you pay to the policies you choose, and even the risks you ignore. Let's break them down. 1. Loss aversion. Let's start with one of the most powerful forces in behavioral economics, loss aversion. It's the idea that losing something hurts twice as much as gaining the same thing feels good. In simple terms, losing 10,000 Kenyan shillings feels way worse than how gaining 10,000 Kenyan shillings would feel good. And guess what? Insurance companies know this, and they use it. Real-world example. Think of those messages you see like, without cover, one accident could wipe out your savings. That's not just marketing. That's loss aversion in action. It taps into your fear of losing what you already have, your car, your money, your peace of mind. This fear makes you more likely to buy cover and maybe even overinsure. And once you have insurance, loss aversion still works on you. People with health or motor insurance often drive more carefully or get checkups more regularly because they don't want to lose the coverage they've paid for or the no-claim bonus they've earned. It's not always logical, but it's deeply human. So, the next time you're tempted to buy more cover out of fear, pause. Ask yourself, am I protecting my future or just afraid of losing something now? 2. Anchoring bias. Anchoring happens when your brain latches onto the first piece of information it sees, whether it's relevant or not, and uses it as a reference point for all future decisions. For example, if the first quote you see is 70,000 Kenyan shillings and the next one is 58,000 Kenyan shillings, that second one feels like a bargain, even if it's still overpriced. Insurers know this. That's why many comparison sites show a recommended plan first. They anchor you high so everything else feels more reasonable, even if it isn't. It's pricing psychology in action. 3. Availability bias. Availability bias is when your brain gives more weight to information that's recent, vivid, or emotional. If you recently watched news of a massive flood in Nairobi or a tragic accident in Mombasa, you're more likely to overestimate the risk of it happening to you, even if the real probability hasn't changed. Insurance companies know this, too. After a major news event, they might promote more expensive policies or upsell disaster protection bundles because they know you're emotionally primed to buy. You're not calculating risk. You're remembering it. 4. Framing effect. Let's talk about the framing effect. How the way information is presented can completely change the decisions we make, even if the facts don't change. Here's the thing. We don't always judge offers logically. We judge them based on how they're framed. Example. Suppose an insurance agent tells you, this policy covers 90% of your hospital bills. Sounds great, right? But if the same agent said, you'll still have to pay 10% out of pocket, suddenly you hesitate. Even though both statements describe exactly the same thing, your reaction changes based on how it's framed, positively or negatively. This happens all the time in insurance. A plan is framed as starting from just 3,000 Kenyan shillings a year rather than 250 Kenyan shillings every month because one feels lighter. You're told, stay covered to avoid penalty loading instead of, you'll get a discount for continuous cover. Same outcome, but the first one sounds scarier and makes you act faster. Insurers know that we respond more strongly to losses or risks than to opportunities, and so they frame things accordingly. Insurance tip: next time you see an offer or a policy, flip the frame. Ask yourself, what's the same fact shown another way? That simple question could save you money and help you make smarter, more confident decisions. 5. The endowment effect. Let's talk about one of the sneakiest psychological biases affecting your insurance decisions: the endowment effect. Here's what it means. Once you own something, you begin to overvalue it simply because it's yours. You didn't choose it because it was perfect. But now that it's yours, you believe it's worth more than it really is. And in insurance, this shows up all the time. Example 1. You've had a life policy since 2015. Maybe the premiums are high. Maybe better options now exist. But when someone suggests switching, your first thought is, no way. This policy has been with me for years. It's no longer about benefits or value. It's about emotional ownership. Example 2. A new insurer offers the same medical benefits at half the cost. But you say, I don't trust them like I trust my current provider. Even though you're not gaining anything new, your mind tricks you into staying put. This is the endowment effect in action. And insurers know this. They lean into it. They build customer loyalty programs, anniversary bonuses, and messaging like, you've been with us since year 2000. All to deepen that sense of ownership. Because the longer you've held a policy, the harder it becomes to let go of it, even if it's no longer serving you. So what can you do? Step back. Ask yourself, if I didn't already own this policy, would I still buy it today? Am I staying because it's good or just because it's mine? Insurance should be based on value, not nostalgia. The truth is, loyalty is great, but smart loyalty is better. 6. Default options. Now, let's talk about default options. Defaults are pre-selected choices that require no effort to accept, but effort to change. And because we tend to avoid friction or decision fatigue, most of us go with the default. This is why you stick with your employer's default health insurance plan, even if another option would serve you better. When a digital platform shows you a recommended or popular plan, you go with it without exploring further. Renewal notices come with auto-renew, pre-selected. You don't uncheck it, so your policy rolls over silently. It's not that we've made a smart choice. We've just made the easy one. 7. Nudge theory. What is nudge theory? Coined by Nobel Prize winner Richard Thaler, nudge theory is the idea that people can be gently guided toward better decisions without being forced. It's not manipulation. It's choice architecture, designing options in a way that highlights what's good for you. Nudges preserve freedom but increase the odds you'll do something smart, safe, or healthy. In insurance, nudges are everywhere and growing fast. Nudges in action. Let's break it down with real insurance examples. Telematics in motor insurance. Usage-based car insurance tracks how, when, and where you drive. Drive well? You're nudged toward a discount on next year's premium. Have anti-theft device installed in your car? You qualify for a lower excess. Harsh braking or overspeeding. You get feedback, not punishment, but that subtle nudge often leads drivers to improve. Wellness programs in health insurance. Some insurers in Kenya and globally reward policyholders for walking, exercising, or getting regular health checks. You're not forced to exercise, but knowing your smartwatch is tracking steps toward a lower premium nudges you to take the stairs. Home safety checklists. Insurance portals now offer safety score tools. Have you installed a fire extinguisher? Do you have CCTV? Rate your gate lock. Every yes nudges you closer to discounts, creating a loop of behavior that lowers risk and premiums. How to outsmart these biases and get real value from your insurance policy. Now that you know the psychological traps that affect your insurance choices, the real question is, how do you beat them? 1. Slow down your decisions. Bias thrives when you're rushed. So, whether you're renewing a policy or buying a new one, take your time. Compare quotes, review your options, and ask questions. Don't buy at the last minute. 2. Question your loyalty. Just because you've been with a provider since 2015 doesn't mean you're getting the best deal. That's the endowment effect talking. Periodically compare your coverage and pricing with other providers. Loyalty should be earned, not automatic. 3. Think long-term, not just monthly. Present bias makes you fixate on today's cost, not the future value. Look beyond the monthly premium. Ask, what will this policy do for me 5 or 10 years down the line? 4. Don't rely on emotion or headlines. If a recent flood or robbery is stuck in your head, that's availability bias at work. Don't overinsure out of fear or underinsure out of overconfidence. Base your cover on real risk, not recent news. 5. Use technology to your advantage. If your insurer offers things like telematics or wellness programs, say yes. These are nudges designed to reward better behavior with better pricing. Bottom line, awareness is power. When you understand your own psychology, you take back control, not just of your premium, but of your financial future. Behavioral economics doesn't just study money. It studies how people behave around money. It looks at the why behind the what. Why do people hesitate to buy insurance, even when they know it's necessary? Why do some overinsure, while others take huge risks with no cover at all? Traditional economics assumes people make rational choices. But behavioral economics knows we're human, driven by emotions, habits, mental shortcuts, and even fear. And in the world of insurance, this knowledge is powerful. It helps companies design better products, communicate more clearly, and anticipate how customers will react. And for you, the consumer, it gives insight into your own thinking, helping you make smarter, more thoughtful decisions about your coverage, your premiums, and your financial future. Because at the end of the day, insurance isn't just about numbers, it's about people. And people don't always act logically. Understanding why can change everything. So the next time you're reviewing your insurance policy or shopping for a new one, remember, It's not just about premiums and paperwork. It's about psychology, patterns, and the little mental traps we all fall into. By understanding behavioral economics, you're not just buying insurance. You're making smarter, more informed decisions for your future. Stay sharp. Stay protected. Don't forget to subscribe to Insurance World TV, where we simplify insurance, expose industry secrets, and empower you one video at a time. Until next time, think smart, insure smarter.